Welcome to the next section of this course, Getting Your Business Investor Ready. And this is a second learning objective, and we're going to look at the investor space. So I hope you have your notepads and your pens ready. This is going to be an amazing, amazing section. So just moving into it, what are the different categories of investment? So it's very key for you to understand this. There are two main categories of investments. The first one is equity investment. I spoke about it a little bit in the first section. Here, the founders or owners of the business trade part of that business, which we call shares, for funding. So you're giving a percentage of your business to an investor for the money or the funding that they're going to give you. So an investor can choose to sell his or her shares at a later time for a higher amount than the initial value that they had purchased the shares for. So that's how they get their return on investment. So this is what we call equity investment. The second category is debt investment. These types of investment are also known as loans. Just think of it as loans, right? So loans can be taken by the business owner and repaid through regular payment schedules at the agreed interest rates. Now, there's another category which is called the grants. Um, this, should I say, type of funding are usually awarded to the business or organization without the intention of repayment. So when you get a grant, you are not going to pay back. You are not giving equity. There is no interest rate received on grants. So they're usually given by, like government, NGOs, big firms, and usually they target businesses that have a social impact factor, or whatever their business model is impacting in the development of the community. So those are the types of businesses that grant funders really, really look for. The only expectation for a grant funding is that the impact is tracked and the reports are usually shared with the funding entity. So, what are the types of investors? Number one, you have the most popular and very easy to get friends and family. They're usually ideal for the very early stage of your business. You're just like you're in the idea phase, right? You've not even registered your business. You just have this crazy idea, and voila, you have your family and friends. Could be your mom or your dad, or your friend, someone who believes or trusts in you and is willing to invest. The second type of investors are the bank SME loans. This is ideal for the growth stage. I mean, we'll deep dive into the investors in the coming slides, but these types of investors are ideal for the growth stage, again because at the startup or launch phase your business is more risky, right? So you're more likely to get support from a bank or get a loan if you are in the growth stage. The third type of investor is the angel investor, and this typically invest in startups or launch stage businesses. So they love to really invest in their risk appetite is much higher. So let's put it that way. They have a higher risk appetite than some of the other investors. The fourth type of investors are the crowd funders, and you can typically get support or funding from crowd funders at any stage. It just depends on how compelling your business idea or business model is, in order for you to raise the funding. The fifth is the venture capitalist, and you'd usually get funding from venture capitalists if you were in the growth pardon me, if you are in the growth and expansion stage. The final one is the accelerators and incubators, and they work with, from pre-seed to startup, launch stage organizations. So let's deep dive into each of these investors. Your friends and families, these are your connections, your contacts. Remember, your network is your net worth. So you need to ensure that you are really building strong connections. You're really building very, very good connections with people, contacts, because you never know who may be in the position to invest in that fabulous idea that you have, right? So yeah, friends and family, they provide early funding, usually called the pre-seed funding. They're prepared to lose 100% of investment because at this stage, if you are in the pre-seed or startup launch phase, your business is more risky. So I mean, they have it at the back of their mind that I may lose my money, and the reason why friends and family would do this is because they believe in you, they trust in you. So providing fund is based on relationship, as I mentioned, with the business owner. They really trust in you, they believe in your idea, and they're willing to take that step, that risk to invest in your business. They may provide funds as loan or equity investment. So we remember we went through the two main categories. So it means that they will give you funding, and it could be a loan in which you pay back over a specific period of time, whatever is agreed, or they want equity as your business grows. They just want a percentage of that business, and that would be a return on investment for them in the years to come. Typically, the size of funding is small, but it will fall between $50,000 and $250,000. I'm just using the USD just to have a currency that is a bit universal. But yeah, typically. Between 50,000 and 250,000 for an average investor appetite. Um, Targets mostly startup stage. So again, family and friends, even your own personal funding, will usually come into play during the early parts of the life cycle of your business. So bank loans, SME loans, banks will provide loans to business owners who meet specific requirements. So they do have requirements. If you're going to take a bank loan, you need to carefully go through all the requirements, read all the documents, and ensure that you understand. But they do provide loans to certain businesses that meet their requirements. So it could be that maybe you're a business in the growth phase, you have X amount of revenues per month, you have X, assets to your name, whatever it may be. You just need to ensure that you fit the criteria. They have, of course, a verification and a due diligence process. In order for them to evaluate the risk, it means that they will do their search and their findings on your business before they give you money, on like your family and friends who may not really even ask for like your CAC document or anything like that. But the banks will definitely run a due diligence process on your business, on you, to ensure that they're effectively evaluating the risk that they are taking by funding your business. They're usually high interest rates depending on the risk level. So the riskier your business, the higher the interest rates. If your business is in the growth or expansion phase, which is less risky, you might get lower interest rates. So depending. Asset financing is also available where the owner uses valuable assets such as land, equipment, inventory as collateral. So if they have this a collateral, right? If you call it that, it's easier for them to, give you the loans, and your interest rate might also be quite minimal depending on the quality of your assets. They target mostly growth stage businesses, and yeah, so moving on to angel investors. Um, Angel investors, as I mentioned earlier, they are their risk appetite is much higher than your venture capitalists. They're typically very wealthy individuals who are willing to invest in startup businesses. I mean, we love angel investors because they take their chances on innovative young startup ideas and founders, which is really, really great. It's a higher risk taking appetite compared to VCs, as I mentioned. And of course, a due diligence process will be done to evaluate your business, even though they are willing to take the risk on startups. They still run a due diligence process. So you need to ensure that your financials, your business is in order, which is, part of why you're taking this course. You need to ensure that you are investor ready, just so that it makes the due diligence process seamless. Um, Usually, angel investors will ask for equity, so that's a percentage of your shares. But you need to ensure that when you're negotiating, you're really negotiating well. You do not want to give up a huge percentage of your shares just for funding. Typically, you shouldn't give up more than 30%. 30% is really a lot, but depending again on the amount of investment that we're talking about. They target startup stage, and the typical range will fall within $100,000 to $2 million, depending on your business model, depending on the needs of your business and how much you are looking to raise. So moving on to crowdfunders, common examples are Kickstarter, Crowdfunder, Fundly, Crowdcube. So they create funding through large groups of people via online platforms, and it's ideal to raise some funds to cover like projects or operating expenses. If you're looking for a couple of thousands of dollars, this is also not it's a good way to raise some funds. A fee is usually charged to the fundraiser. So if you're raising money via these platforms, they will charge you a fee, which you will pay to the site. And then usually the investment can take different forms. It could be equity, it could be the use of services and products, it could be a mix of both, it could be profit sharing. That means once the business becomes profitable, you share the profit with all those who had funded your business. And it could be charity. People use crowdfunding sites for charity purposes. People need money, they need surgery. They use that to raise money for charity as well. And then it could also be a bad debt. So you pay back with interest rates. Moving on to the next, let's move on. Right. So now we're going to look at the venture capitalist. These are private organizations that are interested in funding businesses that have high growth potential. So again, you would see VCs interested in businesses in the growth stage of its business life cycle because of it's less risky. They're really interested in businesses that need funding to scale. So you want to grow. You're currently in Lagos. You want to go to Port Harcourt, or you're in Nigeria. You want to grow to 2 or 3 African countries, right? So VCs are usually interested in businesses that are looking for funding because they want to scale. So there's a need that has been established, and they want to grow their business. The equity investments are usually what you would find with venture capitalists. So they want to own part of the business and also have a level of control at the management level. So this is something for you to think about as well. Usually with venture capitalists, they want to have, they want to either be on your board, they want to have some say in the management of the organization. That helps, of course, to minimize the risk when they have their hands on the management. On part of the management of the organization. So it's important for you to note that. An intense due diligence process is expected. Um, the due diligence process for VCs is usually quite something. Like they're going to dig into your books, they're going to look at your financial records, you're going to provide a lot of data and information about your organization, which is fine. Again, get yourself and your business portfolio investor ready. Very, very important. The funding rate is usually huge, and it could be up to several millions of dollars. So VCs have the money. So looking at the startup schools, which is the last investor that we're taking a deep dive, we're going to talk about the incubators and the accelerators. So the startup schools support young businesses, and they do this by providing resources needed to grow. It could be a workspace, it could be access to experts in the field, and it helps business owners to save on cost and time, and it increases the survival rate of a new business. So if you don't really have much on you, I would strongly encourage you to think about, applying for an incubator or an accelerator within your your country of operation. So incubators help startups to refine their business idea. So usually they will work with you if you are at the pre-seed level, that you're pretty much just have an idea, right? And you just need the support, you just need that mentorship. So incubators will work with you to refine your business idea. They will build out your business model, provide support, as I mentioned, such as workspaces. You probably just pay a rent fee just for the workspace that you have. You get access to experts, consultations, mentorship, and it's usually common examples are co-creation hub in Nigeria. You have mess in Ghana. For the accelerators, they work with startups that already have a minimum viable product. That means they have proof of concept. They really have either started their business operations, but they do have that. It's not just an idea, right? They have a minimum viable product already. And what accelerators do is that they work with these businesses to position them to be able to raise the funding that they need. So they provide the coaching, the mentorship, the training, the connections, also to investors and the business partners. And they help also in just ensuring that you are polished. Let me call it that. You're polished to attract bigger rounds of investors and investing and funding. um, they recruit on a cohort basis with duration lasting 3 to 12 months, and usually they provide their services for equity. So, examples, a very popular example is Y Combinator, which had funded Airbnb, Tizeti, Dropbox, Paystack. I mean, these companies, they pass through this accelerator Y Combinator. um, in the investor portfolio list that you should have received, you will find a comprehensive list of accelerators and incubators that you can readily apply to, depending on which of those accelerators are a best fit for your business. So there's a detailed review in that portfolio list, and at the end of this course we will go through and just have a run through the portfolio list, so that it provides a guide on how best to use that resource. Right. So the key takeaways from this section: research. You need to ensure that you have a clear understanding of what your business needs are and the best investment category that is best fit for you. We looked at all the different types of investors. By now, you should know at what phase your business is in its life cycle. So obviously, now which funding source is pretty appropriate for your life cycle, the life cycle of your business. Again, it's not a one size fit all. It depends on your business model. It depends on the value that you're offering, how compelling your business portfolio is. The second thing is to do your investor due diligence. You want to really research and find what is the right fit for your business. Ideally, you're looking for business industry fit, mentorship, and a strong network. This is even more valuable than, I would rather have an investor give me 10,000 USD and provide me with mentorship, provide me with a strong network of experts in the field or in my business industry, than have someone give me $1 million and they're not like providing any value whatsoever as an investor. So it's very important to note that you should definitely do your due diligence before receiving funding from any investor. Planning. Ensure that you have the right plan and team in place to execute once the funds come in. And this is very, very important. You want to ensure that you are not seeking funds when you have no roadmap to launch, grow, or scale. And then finally, with operations management and internal tracking, ensure that your operations, your business operations are optimal and that you are identifying and removing inefficiencies in your business operations. This is absolutely, absolutely key. So we've come to the end of this section. I hope you found this valuable. So yeah, take a break, relax, take a sip of water, grab lunch, whatever it is, and I will catch up with you in the next section. Thank you.